In 1929, the stock market collapsed and America fell into the Great Depression. Over the next 3 years, stock Fs crashed by 89%. 1 out of every 4 Americans lost their jobs. Banks failed across the country. Life savings disappeared overnight. And it took 25 long years for markets to finally recover to their old levels. Then came 2008. The housing market burst, triggering the Great Recession. Stocks dropped 57% in just 18 months. Unemployment surged to 10%. Banks needed emergency rescues. Retirement accounts were destroyed. And once again, it took years for the system to recover. But the situation in 2025 is different, much more dangerous. For the first time in modern financial history, stocks, bonds, and real estate are all falling together in what experts now call the everything bubble. And when every major asset crashes at the same time, there is nowhere to hide. What if I told you this is not a new situation at all? What if we are actually standing in 1928 all over again, the quiet moment before the Great Depression? Except now it is even worse, because the tools that saved us in 1929 and 2008 no longer exist. The Federal Reserve cannot cut interest rates to 0 because they are already too low. They cannot print unlimited money because they already did that and triggered the worst inflation in 40 years. And the government cannot bail everyone out because it is drowning in $36 trillion of debt. Let me explain why every important financial warning light is flashing red, why the high-risk crash window is between November 2025 and June 2026, and why the coming collapse could destroy more wealth than any event in human history. This is not guesswork. This is basic mathematics. To understand why 2025 is unlike any previous crash, remember this. We are not in a single bubble. We are in 3 huge bubbles happening at the same time, something that has never happened before. Let's start with the stock market. The S&P 500 is trading at a price-to-earnings ratio of 28. The long-term average is around 15 to 17. These extreme valuations have only happened twice before. In 1929, right before the Great Depression, and in 2000, right before the dot-com crash that wiped out nearly 80% of the NASDAQ. Both times, the market collapsed within months. But the danger today goes even deeper because the market is extremely concentrated. 7 companies, Apple, Microsoft, Nvidia, Amazon, Google, Meta, and Tesla, now make up about 30% of the entire S&P 500. If these 7 fall, the entire market falls with them. This level of concentration has not existed since 1929, when a few industrial giants held up the entire market just before the collapse. Even during the dot-com bubble, the concentration was lower than it is now. Nvidia alone is a clear example of how extreme valuations have become. It trades at a price-to-earnings ratio above 65, meaning investors pay $65 for every $1 of profit. The company is valued at more than $3 trillion, making it worth more than the entire German stock market, even though Germany is the 4th largest economy in the world. This is not rational valuation. This is speculation fueled by artificial intelligence hype, just like the internet hype of 1999. The internet did change the world, but short-term valuations were wildly wrong. The same mistake is happening again with AI. Now the second bubble, real estate. And this bubble is even bigger than the one that caused the 2008 financial crisis. As of November 2025, home prices are about 50% above their long-term historical trend compared to income and rent. In 2008, the peak was 35%. That means the current housing bubble is 43% bigger than the bubble that nearly collapsed the global financial system. Think about that. The crisis that required trillions in bailouts and almost broke capitalism was driven by a 35% overvaluation. Today we are at 50%, and because prices have been high for so long, people think it is normal, but residential homes are just part of the story. Commercial real estate is collapsing slowly but steadily, and the damage will accelerate through 2025 and 2026. Office buildings across the country are nearly half empty because remote work has become permanent. In San Francisco, Commercial offices are more than one-third vacant. Most of these buildings were purchased when interest rates were around 3%. Now the loans are coming due and must be refinanced at 7 to 9%. The buildings are not worth enough to support the new payments. This means defaults, bank losses, and a chain reaction of failures similar to the 2008 subprime crisis, but this time the problem is in commercial properties instead of homes. The third bubble, and the one that makes 2025 truly unprecedented, is the bond market. Government bonds have always been the safe place to hide when stocks fall. In 1929, bonds stayed stable while stocks dropped 89%. In 2008, Treasury bonds went up as people escaped the stock market. But in 2025, bonds are crashing at the same time as stocks because the United States has issued so much debt that the bond market cannot absorb it anymore. Federal debt is now above $36 trillion, around 125% of GDP. The last time the debt was this high relative to the economy was right after World War II, when America was the only major country left standing. Today, the U.S. is competing with nations that have stronger finances. The annual interest bill on this debt is now over $1.2 trillion. The single largest expense in the entire federal budget, even larger than defense or Social Security. When interest alone becomes your biggest bill, the government has only three choices: cut spending sharply and cause a recession, raise taxes sharply and cause a recession, or print money to pay the debt and create inflation. All three choices lead to crisis. There is no easy path when your interest payments alone equal the entire GDP of Mexico. This is the reality of the everything bubble. Stocks priced at levels normally seen before major crashes. Real estate more inflated than it was in 2008. And bonds collapsing under the weight of massive government debt. The similarities between 2025 and 1929 are so exact that it feels like watching history repeat itself. In 1929, stock valuations reached levels no one had ever seen, with the Dow trading at 33 times earnings. In 2025, we are in the same zone, with the S&P at 28 times earnings. The public in 1929 believed new technologies like electricity, radio, and automobiles had created a new economy where old rules no longer applied. People repeated the same phrase again and again. This time is different. In 2025, artificial intelligence is the technology that people believe makes old rules obsolete. And just like 1929, leverage is exploding. Margin debt in the late 1920s reached unbelievable levels as everyone from professionals to shoeshine boys borrowed money to buy stocks. Stories spread of ordinary people becoming rich overnight. Today, margin debt as a percentage of GDP is at similar extremes, but leverage is now hidden in more places. Retail investors are trading options at record levels. And yes, some people are even using credit cards to buy stocks. Companies today are borrowing money just to buy back their own shares at inflated prices. Leverage is everywhere in the system, hidden inside derivatives, options, and complex debt structures that most people never see and never understand. Back in 1929, wealth inequality had reached extreme levels. The top 1% controlled around 25% of total income. This meant the entire economy depended on a very small group of wealthy individuals continuing to spend and invest. When they pulled back, the entire system collapsed almost instantly. In 2025, wealth inequality is even worse. The top 1% now controls roughly 32% of total wealth, which is even higher than 1,929. The top 10% controls about 70% of all consumer spending. If the wealthy stop spending because their stock portfolios collapse, consumer demand freezes and the economy falls apart. But here is the part that makes 2025 far worse than 1,929. In 1929, most Americans were not in the stock market. Only about 1 in 10 households owned stocks. That means 90% of the population was not directly hurt when the market crashed. They suffered later through unemployment and deflation. But the initial crash did not wipe out their savings because they were not invested. In 2025, approximately 58% of American households own stocks directly or through retirement accounts like 401ks and IRAs. This means when the market crashes, it immediately destroys the retirement savings of more than half the country. There is no protection, no buffer, no delay. Everyone feels the damage at the same time. The banking system in 1929 was scattered across thousands of small banks, and there was no federal deposit insurance. When panic hit, people rushed to withdraw their money. Banks failed everywhere, and ordinary people lost everything because there was no government guarantee. In 2025, there is FDIC insurance that supposedly protects deposits up to $250,000. But the FDIC only has around $125 billion in its fund, while it insures almost $10 trillion in deposits. If several large banks fail at the same time, the FDIC fund would be wiped out instantly. The government would have to print trillions to make depositors whole, destroying the currency through runaway inflation. In the end, depositors lose their money one way or another, either through bank failures or through the inflation caused by saving the banks. There is no winning option. The Federal Reserve in 1929 still had credibility and room to act. They were a young institution, only 16 years old, and they had not yet burned public trust through decades of boom and bust cycles. They could have cut interest rates more aggressively, but they simply did not understand what was happening until it was too late. In 2025, the Federal Reserve has spent 15 years proving it cannot manage the economy. After 2008, they pumped unprecedented amounts of money into the system through quantitative easing. They kept rates too low for too long, inflating the everything bubble. Then, they hiked rates aggressively in 2022 and 2023, which caused inflation while also threatening to crash the economy. The Fed has lost credibility and, more importantly, it has lost the tools it needs to fix another crisis. The 2008 crisis gives us another clear warning of what is coming in 2025 and 2026. In 2008, the meltdown began with subprime mortgages given to people who could not afford them. These loans were packaged into complex securities and sold worldwide. When housing prices stopped rising, borrowers could not refinance. They defaulted. Those defaults spread through the financial system, exposing the fact that banks were massively overleveraged and holding worthless mortgage-backed securities. In 2025, subprime lending is everywhere, except nobody calls it subprime. Auto loans now stretch to 84 months with high interest rates and borrowers with weak credit. Credit card debt has reached record highs, with average rates above 21%. Student loans total $1.77 trillion, much of which will never be repaid. Corporate debt has exploded from $2 trillion in 2008 to more than $10 trillion today because companies borrowed aggressively at low interest rates to buy back their own stock. In 2008, leverage was mainly concentrated in mortgages and mortgage-backed securities. Banks like Lehman Brothers were leveraged 30 to 1, meaning they had $30 of assets for every dollar of capital. A decline of just 3% wiped them out. Lehman collapsed in September 2008, triggering the worst financial panic since the Great Depression. In 2025, leverage is not trapped in one corner of the economy. It is everywhere. The global derivatives market now exceeds $600 trillion in notional value, which is more than 10 times the size of the entire global economy. Most of these derivatives are interest rate swaps and credit default swaps that could detonate if interest rates move sharply or if major corporations begin to default. Everything is interconnected. One failure triggers another, and that failure triggers more, creating a chain reaction that cannot be stopped. In 2008, the Federal Reserve had powerful tools to fight the crisis. Interest rates were above 5% when the crisis hit, giving the Fed room to cut down to zero. This helped encourage borrowing and spending. The Fed also launched quantitative easing, buying trillions of dollars of Treasury bonds and mortgage-backed securities to inject money into the financial system. The Fed's balance sheet exploded from $800 billion before the crisis to $4 trillion by 2014. This massive money creation prevented a complete collapse at the time, but it also created the bubbles we are dealing with now. In 2025, interest rates are already relatively low. leaving the Fed with very little room to cut. If they slash rates aggressively, inflation could come roaring back, undoing the painful rate hikes needed to tame it. If they refuse to cut rates, the economy could collapse into a deep depression. Quantitative easing is also limited. The Fed's balance sheet is already above $7 trillion after repeated rounds of money printing during and after 2008, and again during the COVID crisis. Printing even more money risks destroying the currency. The inflation from 2021 to 2023, the worst in 40 years, proved you cannot print unlimited amounts without tearing down the dollar's value. The Fed is trapped. Print money and risk destroying the dollar through inflation. Do nothing and allow deflation to pull the country into another Great Depression. The tools that worked in 2008 cannot be used again because they were pushed to the limit. Government bailout capacity is also gone. In 2008, the government had far more borrowing room. Federal debt was about 67% of GDP, which was manageable. The TARP program authorized $700 billion to buy toxic assets. Additional programs raised the total bailout to nearly $2 trillion. It was unpopular, but it was possible because the government still had space to borrow. In 2025, federal debt is 125% of GDP and rising, with trillion-dollar deficits every year. The government does not have another $2 trillion available to bail out failing banks and corporations. If it tries to borrow that much, bond markets will revolt and interest rates will spike, making the debt even less sustainable. The bailout strategy that saved the system in 2008 simply does not exist anymore. The global situation makes everything worse. In 2008, China was booming and helped pull the world out of recession by stimulating its own economy and buying massive amounts of commodities. Europe, although affected, was not drowning in debt like it is today. The G20 coordinated worldwide stimulus programs. In 2025, China is struggling through its own crisis. Its real estate sector is collapsing. Local government debt has reached more than $13 trillion, and its population is shrinking, creating a long-term demographic disaster. Europe is facing an energy crisis, declining populations, and political fragmentation that weakens its ability to respond. There is no major economy today that is in any position to lead a global recovery. Geopolitical tensions are rising everywhere, and cooperation between nations is increasingly unlikely. When the crisis hits, every country will be focused on its own survival, rather than on coordinating global solutions. For more than 70 years, the most reliable predictor of upcoming recessions has been the inverted yield curve. Whenever short-term interest rates rise above long-term rates, it has predicted every single recession since 1950 without a single false signal. The yield curve inverted in July 2022 and stayed inverted for 27 months before finally returning to normal in September 2024. History shows that recessions typically begin 3 to 12 months after the curve reverts to normal, not while it is inverted. That places the danger zone between October 2024 and September 2025. We are living in that exact window right now. The indicator that has never been wrong is warning that a recession is imminent. Consumer debt has reached levels that make the 2008 crisis look mild by comparison. Credit card debt now exceeds $1.14 trillion, which is the highest ever recorded. The average credit card balance per household is around $6,800, with interest rates often between 21 and 28%. Delinquencies, meaning borrowers who are 90 days or more behind on payments, have jumped to the highest levels since 2011. This is critical because consumer spending represents 68% of the entire United States economy. When consumers can no longer borrow, when their credit is maxed out, and when they have to pay down debt instead of spending, the economy shrinks. We have reached the point where consumers are stretched to the limit. They simply cannot sustain the level of spending the economy depends on. The commercial real estate crisis is unfolding slowly, but will intensify dramatically throughout 2025 and 2026. More than $2 trillion in commercial mortgages come due during this period and must be refinanced. These loans were originally created when interest rates were around 3%. Today's refinancing rates are between 7 and 9%. A building that barely generated enough cash flow at 3% becomes financially unviable at 8%. The numbers no longer work. Property values have fallen 40 to 60% in many cities because buyers understand the buildings cannot support their debt at current rates. When these mortgages cannot be refinanced, owners will default and surrender the properties to lenders. Regional banks that hold these loans will face enormous losses that wipe out their capital. The warning signs were already visible. In 2023, several major regional banks failed even before a recession began. Silicon Valley Bank collapsed in March 2023, marking the second largest bank failure in American history. Signature Bank failed that same week. First Republic Bank fell in May 2023 and had to be absorbed by J.P. Morgan, with the FDIC covering massive losses. New York Community Bank was on the brink of collapse in January 2024. These failures happened during economic expansion. When the actual recession hits and loan defaults surge, many more regional banks will go under. The FDIC's $125 billion insurance fund will be depleted within weeks. The government will have no choice but to print money to guarantee deposits, which will rapidly devalue the currency. The extreme concentration of market value in 7 companies, often referred to as the Magnificent Seven, has created a level of fragility that did not exist in previous eras. Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta, and Tesla now make up 30% of the entire S&P 500. Nvidia alone, with a price-to-earnings ratio above 65, accounts for nearly 7% of the index. If Nvidia's earnings disappoint, or if the enthusiasm for artificial intelligence cools even slightly, its stock could fall 50 to 70%. That drop, driven by a single company, would drag the entire market down with it. This level of concentration is something financial markets have never seen before. When the crash comes, these 7 companies will lead the decline, and because they represent so much of the index, the fall will be faster and more severe than anything in recent memory. Insider selling has also reached levels that historically occur just before major market collapses. Corporate executives see the real numbers behind the scenes. They know the actual earnings, the true outlook, and the problems the public cannot see. When they begin selling massive amounts of their own stock, it is a clear signal that they do not believe current prices can be sustained. Jeff Bezos sold more than $13 billion of Amazon stock throughout 2024 and 2025. Mark Zuckerberg has sold billions of dollars of Meta shares. Nvidia executives sold significant amounts of stock even as prices hit new highs. This is exactly what happened in 1929 and again in 2000. Insiders always exit before the crash. Warren Buffett, widely considered the greatest investor in history, is sitting on more cash than ever before. Berkshire Hathaway now holds over $325 billion in cash, the largest cash position in the company's history. Buffett has been reducing stock holdings, including trimming his enormous Apple position and buying short-term treasury bills instead. When asked why, he explained that valuations are too high and attractive investments are impossible to find. His own valuation measure, known as the Buffett indicator, compares the total value of the stock market to gross domestic product. Buffett has said that a reading above 120% indicates dangerous overvaluation. In 2025, the indicator sits at 185%. For Buffett, the message is clear. He is waiting for the crash because he believes it is unavoidable. Unemployment is another major warning signal. It has risen from a low of 3.4% in early 2023 to 4.1% by October 2025. While 4.1% may still sound low, what matters is the rate of change. Economist Claudia Sahm created a metric known as the Sahm rule, which states that when the 3-month average unemployment rate rises half a percentage point above its lowest level over the past 12 months, the economy is already in recession. This rule has accurately predicted every recession since 1970 without a single false positive. As of October 2025, we are at or extremely close to triggering this rule. Once unemployment begins climbing, the cycle accelerates as layoffs lead to more layoffs. Auto loan delinquencies have surged to levels not seen since the 2008 crisis. Around 7.5% of auto loans are 90 days or more past due, the highest rate since 2009. Average monthly payments on new vehicles now exceed $740, and loan terms stretch across 84 months. This is subprime lending under a different name. People who cannot afford cars are being approved for loans they cannot realistically repay. When they default, the impact goes beyond the lender. Losing the car can cost them their job, setting off a chain reaction of financial decline. Auto loan defaults are one of the earliest and clearest signs of stress in the consumer economy. Student loan delinquency rates have also spiked since payments resumed in October 2023 after a 3-year pause. Total student loan debt now stands at $1.77 trillion across 43 million borrowers. Many are choosing to default because the debt has grown so large that repayment feels impossible. The result is more than $100 billion removed from the economy every year as younger Americans spend their money servicing debt rather than buying homes, starting families, or contributing to economic growth. The very generation that should be driving the economy forward is instead drowning in obligations that offer no real return. Geopolitical risks in 2025 add another layer of instability. Wars continue in Ukraine and the Middle East. Tensions surrounding China and Taiwan remain high. Global trade is fracturing into rival blocs. Any escalation in these regions could disrupt energy supplies, food production, or critical supply chains. A major oil shock, similar to the 1970s, would create stagflation, the deadly combination of high inflation and recession that is even harder to manage than either problem alone. Markets react poorly to uncertainty, and global uncertainty in 2025 is as severe as anything seen since the Cold War. Commercial real estate defaults have already begun among major institutional owners. Brookfield Asset Management, one of the largest real estate investors in the world, defaulted on 2 major office towers in Los Angeles in 2024. This is just the beginning of what is likely to become a wave of defaults across the country. Blackstone, the largest commercial real estate owner in the world, has been struggling to meet redemption requests from investors who want their money back. These investors are not amateurs. They are sophisticated, experienced players. When even the smart money starts walking away from properties, it signals something deeper. It means the numbers no longer work at today's interest rates. And when major firms start defaulting, it is a sign that the fundamentals have already broken. These defaults will continue spreading through 2025 and 2026 as more commercial mortgages come due, setting off bank losses, additional defaults, and eventually bank failures. The crash will not begin with a single dramatic moment that everyone immediately recognizes. It will start with something that seems manageable. It could be an earnings miss from a major tech company, the unexpected failure of a regional bank, an escalation in a geopolitical conflict, or a breakdown in debt ceiling negotiations. The exact trigger almost does not matter because the system is already so fragile that any shock will start the chain reaction. What matters is the sequence that follows, as one failure causes another, which triggers another, until the entire financial system is in freefall. When NVIDIA, or any of the major tech giants in the Magnificent Seven, reports weaker than expected earnings or gives disappointing guidance, algorithmic trading systems will react instantly. In a matter of seconds, they will begin dumping shares. NVIDIA's stock could fall 10 to 15% in a single day. Because NVIDIA represents around 7% of the S&P 500, that drop alone would pull the entire index down by nearly 1%, but the real damage comes from the psychological shock. If the story driving the artificial intelligence boom begins to crack, investors will start questioning all tech valuations. Microsoft, Apple, Amazon, Google, Meta, and Tesla would all fall sharply in response. Within only a few days, the Magnificent Seven could lose 20 to 30% of their value, dragging the broader market down 6 to 9%. This kind of decline triggers margin calls, and margin calls are what transform a downturn into a full crash. When investors buy stocks with borrowed money, falling prices force brokers to demand more collateral. If the investor cannot provide it, the broker sells the shares automatically. This forced selling pushes prices lower, which creates even more margin calls, which leads to more forced selling. The same downward spiral happened in 1929. In 2025, Margin debt as a percentage of total market value is just as high as it was back then. When the selling starts, it will be fast and relentless. Institutional investors who manage trillions for pension funds, endowments, and sovereign wealth funds also play a key role. They have strict risk management rules that require them to reduce exposure once losses pass certain thresholds. These decisions are automatic, not emotional. When stocks fall 20%, risk algorithms begin selling to limit further downside. This creates additional downward pressure. Within the first month of a crash, the market could easily drop 30 to 40% as retail panic, margin calls, and institutional selling reinforce each other. As the cascade spreads, investors flee toward what they believe is safety, usually the Treasury bond market. But in 2025, Treasury bonds are not safe. The government needs to issue trillions in new debt to cover deficits and refinance existing obligations. When a surge of panicked investors tries to buy bonds at the same time the government is flooding the market with new supply, interest rates shoot higher instead of falling. This is the beginning of a doom loop. Rising interest rates increase the government's already massive interest payments. Higher interest payments require more borrowing. More borrowing requires issuing even more bonds. Issuing more bonds pushes interest rates even higher. Economies trapped in this cycle often end in either outright default or a currency collapse driven by inflation. The housing market freezes as the crash deepens. Buyers disappear, and sellers refuse to accept lower prices. Homes sit on the market for months without offers. Families who must sell due to job changes or financial pressure begin cutting prices. These lower sales set new comparable values that pull down prices across entire neighborhoods. Within 6 months, home prices could drop 20 to 30% from their peak. Within a year, 40 to 50% declines are realistic in overheated markets like Austin, Phoenix, Boise, and parts of California and Florida. Homeowners who bought in the past 3 years find themselves underwater, owing more on their mortgages than their homes are worth. Commercial real estate defaults accelerate as owners realize refinancing is impossible. They stop making payments and hand the keys to their lenders. Regional banks, which often hold these loans, take ownership of properties worth 40 to 60% less than the loan amount. These losses wipe out bank capital. Banks must maintain a minimum level of capital by law. When losses push them below the required threshold, regulators shut them down. During the 2008 crisis, 465 banks failed over 5 years. In the upcoming crisis, we could see similar numbers in a much shorter time. Bank failures create fear among the public. Even healthy banks become targets of panic. Depositors withdraw funds from any bank they think might be vulnerable, creating classic bank runs. No bank has enough cash on hand to meet all withdrawal requests at once, because banks lend out deposits or hold them in long-term investments. When a bank run begins, the bank must sell assets quickly to raise cash. Selling assets at distressed prices creates losses that can push even a strong bank into insolvency. The FDIC steps in to protect depositors, but its $125 billion insurance fund cannot handle multiple large failures. The government will have to print money to guarantee deposits, starting the inflationary process that weakens the currency. Employment collapses as businesses cut costs to survive. Tech companies that grew bloated during the boom begin laying off 10 to 20% of their employees. Financial firms exposed to markets cut staff. Consumer-focused companies facing weak spending close stores and eliminate positions. Within 3 months of the crash, unemployment could rise from 4% to 7 or 8%. Within 6 months, 10% unemployment becomes realistic. Within a year, joblessness could reach 12 to 15% as the cascading failures spread across the economy. At this point, the Federal Reserve faces an impossible choice. It can slash interest rates and begin another round of money printing to try to stabilize the system. But choosing to cut rates and print money comes with its own danger. Doing that too aggressively could reignite inflation before it has fully cooled. Everyone remembers what happened between 2021 and 2023 when inflation reached 9% and destroyed purchasing power across the country. If the Federal Reserve prints trillions again, the dollar will collapse, and inflation will return even worse than before. The alternative is letting the crash run its course, which would mean unemployment reaching depression levels and the economy entering a decade of stagnation. There is no middle option. The tools that worked in 2008 simply do not work in 2025 because they have already been exhausted and everyone understands the consequences of using them again. For the average American with a 401k or IRA, seeing their retirement account fall 60 to 70% will be devastating in ways that go far beyond the numbers. Imagine someone who spent 30 years saving and has $600,000 put away. They would watch it collapse to $200,000 or less. That is not a correction. That is the destruction of their financial future. They cannot retire. They are suddenly forced to work an additional 10 to 15 years, and that assumes they can even keep their job through the recession. For people already retired and relying on withdrawals from their portfolios to cover daily living expenses, the outlook is even worse. They will be forced to sell assets at the absolute bottom just to pay bills, locking in losses that they will never recover. The psychological damage from watching everything you spent a lifetime saving disappear cannot be overstated. In 2008, retirement accounts dropped significantly, but eventually recovered within 5.5 years. Most people who held on managed to return to their previous balances. In the coming crash, recovery will take much longer, if it happens at all. Japan's stock market crashed in 1990 and did not return to those highs until 2024. That was a 34-year wait. Entire generations of Japanese investors never regained their wealth. The same outcome is possible in the United States if the crash is severe enough and the recovery stretches out over decades. The destruction of housing wealth will trap millions of Americans in homes they cannot afford to sell. Young people entering the workforce in 2026 and 2027 will face one of the harshest job markets in modern history. Companies will not be hiring. The few positions that do exist will attract hundreds of applicants. This generation will start their careers 5 to 10 years behind where they should be, permanently reducing their lifetime earnings. Studies of students who graduated during the 2008 crisis show they earned less over their entire careers compared to those who graduated just a few years earlier. The coming downturn will be worse, meaning the long-term economic damage will be deeper. Small businesses will be devastated as consumer spending collapses and credit becomes nearly impossible to obtain. Family-owned restaurants, local service businesses, small retail shops, all will face closures by the hundreds of thousands. Large corporations with access to capital markets will survive, although in a reduced form. As a result, the post-crash economy will be even more dominated by enormous corporations, with small businesses playing a far smaller role. This loss of small business activity weakens competition, innovation, and the overall dynamism of the economy. Social safety nets will be pushed to the breaking point as unemployment rises and government revenues fall. The government will be trapped between rising demand for assistance and a shrinking ability to fund essential programs. Spending cuts will become unavoidable at the exact moment when millions of people desperately need help. This will turn an economic crisis into a humanitarian crisis as vulnerable groups, including the elderly, disabled, and unemployed, face reduced support when they need it most. Political instability always follows an economic collapse. The 1,930 saw extremist movements take hold across Europe as economic desperation made populations vulnerable to radical promises. Hyperinflation in Weimar Germany helped pave the way for the rise of authoritarianism. The United States is not immune to the political consequences of economic catastrophe. When people lose everything, they search for someone to blame and for leaders promising drastic solutions. The crash in 2025 will reshape American politics in ways that cannot yet be predicted, but the shift will almost certainly be destabilizing. So why is 2025 considered worse than 1,929 and 2008 combined? Because we now face the stock market excesses of 1,929, the housing and credit bubbles of 2008, and a government debt bubble that neither of those eras had to deal with. All three are occurring simultaneously. In 1929, the stock market collapsed, but only 10% of Americans were directly invested. In 2008, housing collapsed, but the government could borrow to bail out the banks, and the Federal Reserve could print money without triggering inflation. In 2025, everything is crashing at the same time, and the tools that once worked are no longer effective. The Fed cannot cut rates to zero because inflation is still too high. It cannot print unlimited money because doing so recently caused the worst inflation in 40 years. And the government cannot bail everyone out because it is already buried under $36 trillion of debt. The 12 warning signs I laid out, from the inverted yield curve to Warren Buffett's enormous cash position, are not theories. They are facts. They are happening right now. The same yield curve that has predicted every recession since 1950 is signaling that a recession is imminent within the next 3 to 9 months. Regional banks are failing. Commercial real estate is collapsing. Consumer debt is at record levels with rising delinquencies. Unemployment is trending upward. Insider selling is reaching levels historically associated with major crashes. Every major indicator is flashing red at the same time. The timeline is clear based on the yield curve normalizing in September 2024. Recessions normally begin 3 to 12 months later. That places the danger window between December 2025 and September 2026. Commercial real estate refinancing peaks through 2025 and 2026. Credit card defaults are climbing right now. The trigger could appear at any moment, and once it begins, the chain reaction will be impossible to stop. This is not guesswork. This is pattern recognition. The same warning signs that came before 1929 and 2008 are here again, only more severe. When the crash arrives, stocks could fall 65 to 80% from their peak, a decline even more concentrated and violent than the 89% drop in 1929. Bonds could fall 35 to 50%, something that did not happen in past crashes. Real estate could lose 40 to 60% of its value, worse than the drop in 2008. Unemployment could surpass 15%. Recovery will not take just 5 years like it did after 2008. It could take 10 to 20 years or more because the Federal Reserve has no tools left and the government has no capacity to borrow. The everything bubble earned its name because everything collapses at the same time and there is nowhere to hide. The historic market crashes we read about in textbooks, the ones experts said would never be repeated because we supposedly learned from the past, are about to return with a scale and intensity that will shock anyone who believes it cannot happen. The mathematics of overwhelming debt, overvalued assets, and exhausted policy options make it unavoidable. The crash is coming. The only question is whether you will be ready when it arrives.